Welcome to the second quarter of 2024's market recap. I'm Kezia Samuel, Deputy Chief Investment Strategist. The technology boom drove global equities higher in the first half of 2024. Broad commodities gained as gold, silver, and copper rallied, driven by higher inflation as well as demand to power the energy needs for AI technology. Lastly, interest rate sensitive investments like global bonds and REITs continue to struggle as interest rates have remained higher and are still negative for the year. For investors, a globally diversified 60/40 portfolio is up 5.7%, powered by stocks despite negative returns in bonds. Within equities, the mega cap tech rally is what really drove the S&P 500 higher. In fact, it hit 31 new highs in the first half of 2024. In contrast, international equities, both across developed regions as well as emerging markets and dividend stocks, despite having positive returns, have lagged in comparison. Perhaps the widest gap of performance is seen in U.S. small cap stocks, which remains negative for the year. What this tells me is that if you've got a diversified portfolio, your returns are not going to be identical to those of the brilliant S&P 500 for the first half of 2024. Another noteworthy trend is that within the S&P 500, it was a handful of stocks that really drove those returns. In fact, if you look at the top 5 stocks in the S&P 500 related to AI, and you pull those returns out, returns for the second quarter goes from 4.3% to in fact negative. And for the year to date, as well as when this AI-driven trend began back in November of 2022, if you take the top 5 stocks out, returns get cut in less than half. As these stocks driven by AI have become more expensive as well as bigger, they have now taken a larger chunk in the S&P 500 index. The top 10 stocks represents 37% of the S&P 500 index and now have surpassed the last peak of seen of 28% back in 2000s during the tech bubble. Now, today, the top 10 stocks are not like those back in the tech bubble. They are profitable, but we do know that no trend persists in perpetuity, and at some point, the concentration will likely dissipate. We saw this back in the 2000s decade, which was known as the lost decade, where large cap growth stocks, as well as the S&P 500 as a whole, struggled. In that decade, though, it was not lost for all investments. Boring bonds were up 85%, just like small cap stocks, and emerging markets were up 160%. All investments today that are remaining out of favor. Just as a reminder for investors in times of concentration to remain balanced and diversified and maintain discipline. With that, thank you for listening today and hope everyone has had a wonderful summer.